Welcome to Plato's Cave for our December 29, 2014 broadcast. My name is Doris Motormouth and I am your Poseidon news anchor. Canadian oil surge to US. Gulf puts Mexico on defensive. Bloomberg. A price war is brewing between Canada and Latin America over who will satisfy US Gulf Coast refiners' hunger for heavy oil. The new Seaway Twin Pipeline will almost double the amount of heavy Canadian crude coming to Gulf terminals and plants to about 400,000 barrels a day starting in January, according to Calgary-based ARC Financial Corporation. The shipments are growing even without the Keystone XL pipeline, which has been delayed for 6 years because of environmental opposition. The Canadian supply will square off against crudes from Mexico and Venezuela that have traditionally fed refineries along the Texas and Louisiana coasts. State-owned Petróleos Mexicanos widened its discount for U.S. buys in December by the most since August 2013. Valero Energy Corporation and Marathon Petroleum Corporation, which invested in special equipment to refine heavy crude, stand to gain the most from the Canadian supply. "Something's going to have to give," said Ed Morse, Citibank's head of global commodities research in New York. "It's going to have to be a combination of Latin American countries exporting less into the US or Canadian crude being re-exported and competing with crudes in other markets. Particularly Europe. Transport south. New pipelines and rail terminals enabled more Canadian oil to head south to higher value markets, partially offsetting a 48% collapse in global prices since June as the Organization of Petroleum Exporting Countries refused to cut production to counter a global glut. The discount of Western Canadian Select priced in Hardisty, Alberta, to Mexico's Maya crude has narrowed this year by more than half to $11 a barrel. Heavy Canadian crude will cost the same in Houston as Maya arriving by tanker, including the cost of transportation, according to data compiled by Bloomberg. Pemex widened the discount it gives U.S. buys of Maya to $3.70 a barrel in January, from 90 cents in November. Pemex spokesman didn't respond to several emails requesting comment on the company's market strategy. Latin American producers will price their crude to make sure it's still attractive, said John Owers, executive vice president at Dallas-based Turner Mason & Company, an energy consulting firm. "It won't all disappear anytime soon," he said. "The Gulf Coast is the natural home for it." Higher prices. West Texas Intermediate fell $1.04 to $53.69 a barrel at 12:35 p.m. on the New York Mercantile Exchange. Brent, the global benchmark, dropped $1.25 to $58.20 on the ICE Futures Europe Exchange in London. Canadian output has grown in the last decade as rising prices made it economic to use steam recovery and bitumen mining in the Alberta tundra. Shipments to the U.S. rose 63% in 5 years to a record 3.1 million barrels a day as of September, U.S. Energy Information Administration data show. The flow to the U.S. increased without Keystone XL, an $8 billion conduit that TransCanada Corporation wants to build from Hardisty to an existing network in Steel City, Nebraska. The project is awaiting a decision by the Nebraska Supreme Court on a legal challenge and then a final determination by President Barack Obama's administration. Enbridge Incorporated operates a system that can ship 2.5 million barrels of crude from Canada to the Midwest, and last month finished a line extending to Cushing, Oklahoma. Enbridge and Enterprise Products Partners LP built the 450,000 barrel a day Seaway Twin to double capacity to Houston from Cushing. TransCanada's existing system can bring 540,000 barrels a day from Canada to the U.S. Midwest, and the company built a 700,000 barrel a day line from Cushing to Texas last year. Fewer imports. While Canadian shipments have grown, imports from elsewhere contracted. U.S. refineries took in 4.3 million barrels of crude a day from the rest of the world in June, the lowest amount since 1992. Mexico sent 675,000 barrels of heavy crude a day to U.S. Gulf refineries in September, down from 835,000 for that month in 2012. Venezuelan shipments fell to 700,000 from 900,000. If Canadian crude can't find a home on the Gulf Coast, producers may re-export it elsewhere. The U.S. bars most exports of its own oil, while allowing shipments of foreign petroleum that is kept separate from domestic supplies. The Commerce Department granted 86 re-export licenses from October 2013 through August. Cargoes have gone to Switzerland, Spain, Singapore and Italy this year, according to the U.S. Energy Information Administration. Heavy processing countries including Brazil and Saudi Arabia are investing in heavy oil plants now, though most of the ability to process those crudes is on the U.S. Gulf Coast, where refiners invested billions to buy cokers and desulfurization units to process heavy crude from Latin America. U.S. refineries built out their capacity to run heavy barrels, Oz said. Refineries in the rest of world aren't built to run heavy barrels. The lack of alternative markets for heavy crude means Latin American countries will battle to maintain their share in the U.S., said Stephen Schork, president of the Schork Group in Villanova, Pennsylvania. We haven't seen anything like this, Schork said. This would be a first.
Bloomberg. Search crew scouring the Java Sea for a missing AirAsia BHD. AIRA passenger jet failed to find any trace for a second day as authorities suspect the plane carrying 162 people crashed into the waters off Indonesia. 12 vessels were joined by dozens of inflatable boats and 6 warships as well as military aircraft from Indonesia, Malaysia, Singapore and Australia to scour an area stretching to more than 11,000 square nautical miles. Aerial searches are usually suspended at night while ships will continue their hunt. The Indonesia team suspects the plane is underwater, Search and Rescue Agency Chief F.H. Bambang Sulistyo said in Jakarta today, with no signal detected from the emergency local transmitter. Contact with Flight QZ8501 was lost yesterday while the plane was on a routine commercial flight to Singapore from Surabaya, Indonesia, a journey that normally takes 2 hours. Based on the coordinates given to us, our evaluation says the likely position where the plane crashed is in the sea, Sulistyo said. The preliminary assumption is that the plane is at the bottom of the sea. The hunt for the Airbus Group NV, AIR A320 single-aisle jet is focused on Kumai Bay. Poor visibility could hamper the effort, Indonesia's Vice President Yusuf Kala said. The waters in the area are generally shallow, with depths of no more than 60 meters, 197 feet and warm temperatures that make diving easier. Flight 370, the first planes that reached the region where the AirAsia plane was last reported, didn't find any signs of the missing aircraft, Sutono, a communication director at the Indonesian Search and Rescue Agency, said today. Searchers focused on an oil spill seen 100 nautical miles off Belitung Island. Aditya Jono, spokesman for Indonesia's Air Force, told reporters. Objects spotted by one of the search planes later turned out to be unrelated to the aircraft, the Air Force said. The plane wasn't equipped with the satellite-based tracking system that is more routine on long-distance aircraft, according to Inmarsat plc in London. Shares of AirAsia dropped 8.5% in Kuala Lumpur trading, their biggest slide since 2011. While AirAsia is based in Sepang, Malaysia, it operates with subsidiaries and affiliates in different countries. The missing plane belonged to its Indonesian operations. We're devastated, but we don't know what's happened yet, Chief Executive Officer Tony Fernandes said at a press conference in Surabaya yesterday. Golden hour, the AirAsia pilots didn't send a distress signal, drawing comparisons with Malaysian airline system BHD. MAS Flight 370 that disappeared on March 8 en route to Beijing from Kuala Lumpur. No wreckage from that flight has been found in what's become the longest search for a passenger jet in modern aviation. AirAsia QZ8501 was at 32,000 feet when the pilots requested to fly higher to avoid clouds, Indonesia's acting air transport director Joko Muratmojo said in Jakarta. Air traffic controllers didn't respond to the request before the plane disappeared off radar, National Transportation Safety Committee head Tadang Kurniadi said at a press conference. Indonesia may complete the transcript of the conversation between the air traffic control and AirAsia pilot by tomorrow. There were storms along AirAsia's flight path, AccuWeather.com said on its website, citing its meteorologist Dave Samuel. Storms are very active this time of year, Samuel was cited as saying, with December and January the wettest period of the year in Indonesia. The last signal from the plane was between the city of Pontianak on Borneo and the town of Tanjung Pandan on Belitung Island. The search was initially concentrated around Belitung, Transport Minister Ignatius Jonan said earlier. Sulistio said the search area had been widened to include the Karimata Strait and land areas in western West Kalimantan. Robert Mann, head of aviation consultant R.W. Mann and Company in Port Washington, New York, said searchers missed crucial daylight hours because authorities in Indonesia took an hour and 38 minutes to classify the plane as missing. It's the golden hour in an accident scene. You only have so many daylight hours, he said in a phone interview. AirAsia had no fatal crashes in its history of more than a decade of operations. The A320 has built a reputation as a sturdy workhorse, with more than 6,000 A320 family aircraft in service to date with over 300 operators. The plane that disappeared was delivered to AirAsia from the production line in October 2008. Powered by CFM56-5B engines built by a joint venture of General Electric Company and France's Safran SA, SAF, the aircraft had accumulated approximately 23,000 flight hours in some 13,600 flights, Airbus said on its website. The A320 and the related A318, A319 and A321 have among the lowest accident rates of modern commercial aircraft, with a fatal crash in about 1 in every 7 million departures, according to a study published in August by Boeing Company, BA. The last fatal accident involving an Airbus single-aisle plane was in 2010, when an A321 operated by Pakistani carrier Air Blue crashed into rugged terrain in heavy rain, killing all 152 people on board.
This surface was generated from our Poseidon Alpha software. It represents the S&P 500 of the last 90 days of trading. The last closing price is from December 26, 2014. The blue dots represent the drift and volatility of the returns of that day. The surface is parameterized for the last 90 days of the adjusted closing prices and with a 5 days window for drift and volatility. This volatility surface shows that early volatility was relatively low in this 90 days time frame. About a quarter way into the time series, the volatility increased to a peak of 0.016 and then decreased to a level of 0.000592 about 3 quarters through the time series. As can be shown in this surface, the last quarter of the time series has increased in volatility from the volatility lows, but the last closing price has substantial reduction in volatility. In terms of drift, the time series starts at about zero drift and then becomes turbulent for much of the remainder of the 90 days. What is noteworthy is the 5 days drift window increases substantially the last few trading days before December 26 closing. The drift trend should be positive in the near term with lower volatility. The RSI was 61.8, the MACD was 11.8 for fast component and 7.11 for slow component. Both the RSI and MACD show bullish signs of trend.
Shake Shack files for IPO that could value it at $1 billion. Bloomberg. Shake Shack Incorporated is going public and may be worth as much as $1 billion. Not bad considering New York restaurateur Danny Meyer started the joint as a public service. Founded more than a decade ago to help support the restoration of Manhattan's Madison Square Park, Shake Shack was an instant success, drawing long lines of urbanites attracted by Meyer's modern spin on a roadside burger stand. Today, Shake Shack has more than 63 outlets in 30-plus cities from London to Dubai. It's also profitable, with sales of nearly $84 million in the 39 weeks through September 24, the filing shows. The company, which will list early next year on the New York Stock Exchange, ticker SHAK, is aiming for a $1 billion valuation in the initial public offering, people familiar with the matter said in September. Shake Shack's SEC filing Meyer, 56, is credited with founding some of New York's most prestigious eateries, including Gramercy Tavern, 11 Madison Park, and Union Square Cafe, which he opened 3 decades ago. Born and raised in St. Louis, He serves as chairman of Shake Shack, and his Union Square Hospitality Group LLC also operates a catering business and hospitality consulting services. Shake Shack started as a hot dog cart that later became a permanent kiosk and neighborhood fixture. Hungry urbanites have been known to hop the subway and travel 15 minutes to get their fix of $4.95 burgers and $5.15 shakes. Besides burgers and fries, the chain sells the frozen custard Meyer enjoyed as a boy in St. Louis. Better Burger Meyer's timing was auspicious. Shake Shack joined the Better Burger boom as foodies from Los Angeles to New York began clamoring for food that tasted good and used sustainably raised ingredients. Much like many fast casual joints these days, Shake Shack advertises 100% all-natural Angus beef, vegetarian-fed, humanely raised and source-verified. In the U.S., Shake Shack plans to open 10 new company-operated stores each year starting in 2015, and expects it could grow from 31 company-operated stores to 450 over the long term, it said in the filing. The company didn't say how long it will take to reach that target. Shake Shack used a $100 million placeholder for the IPO, a figure to calculate fees that may change. The company has applied to list its shares on the New York Stock Exchange under the symbol SHAK. In addition to making a payment to Meyer and early backers including Leonard Green Partners and Partners LP, the company plans to use its IPO proceeds to repay debt, open new Shake Shack restaurants and renovate existing ones. JP Morgan Chase & Company and Morgan Stanley are managing the offering. Because Shake Shack filed as an emerging growth company under the Jumpstart Our Business Startups Act, or Jobs Act, it must wait at least 21 days before officially marketing its share sale. Other restaurants chains have been tapping the public market this year, capitalizing on investors' appetites for new and growth stocks. Pizza seller Papa Murphy's Holdings Incorporated, FRSH, raised $63.8 million after going public in May, while chicken chain El Pollo Loco Holdings Incorporated, Loco, has gained about 40% since its July IPO.
Why Greece's spillover across euro area will probably be contained this time. Bloomberg. Greece's flirtation with an exit from the euro in 2011 and two cliffhanger elections in 2012 prompted the darkest days of the debt crisis, halted only by the European Central Bank's pledge to save the currency come what may. Now, with the collapse of another Greek government, Europe's leaders, its more vulnerable economies and financial markets are better prepared. While euro in or out threats will echo through the Greek election campaign, the spillover across Europe this time is likely to be contained. We're looking at a Greece problem. The euro crisis is over, Holger Schmieding, chief economist at Berenberg Bank in London, said by phone. The euro crisis was all about contagion risk. I do not expect markets to seriously contest the contagion defenses of Europe. Investor reaction to the Greek parliament's failure to pick a president traced the familiar north-south divide. Greek stocks and bonds plunged and markets were buffeted in Italy, Portugal and Spain, while funds flowed into Germany, Europe's biggest economy and hard money bastion. Yet look closer, and Italy, the Eurozone's second most indebted country after Greece, is nowhere near a fiscal calamity. 10-year borrowing costs are hovering around 2%, compared to over 7% at the height of the crisis. Bondholders are charging Italy 144 basis points more than Germany to borrow, a far cry from 553 basis points in November 2011. Significance downplayed. Countries along Europe's edges are better equipped now, thanks partly to the ECB's likely start of sovereign bond purchases, said analysts at JP Morgan Chase & Company led by David Mackey. Especially Spain and Ireland have turned the corner economically, they said. Distress in Greek financial markets has historically impacted negatively other markets, but we are inclined to downplay the medium-term significance of the Greek political crisis for bonds elsewhere in Europe, the analysts said in a note to clients. Greece leant over the precipice today when Prime Minister Antonis Samaras fell short of a parliamentary supermajority to elect his candidate for the country's largely ceremonial presidency. That forced a new parliamentary election pitting Samaras, who came to power in 2012 after initially challenging the terms for Greece's €240 billion, $293 billion, rescue package, against Alexis Tsipras of the Syriza party, who never stopped challenging them. No alternative. There were echoes of 2012 in today's European political reaction. Back then, German Finance Minister Wolfgang Schäuble said we cannot force Greece to press on with the budget cuts needed to stay in the Eurozone, while a German then on the ECB board, Jonas Mussen, said there was no alternative to austerity. Schäuble reprised that line in a statement today, saying that tough reforms in Greece were bearing fruit and they are without any alternative. Germany will support Greece on its path of reform, he said, though if Greece chooses a different way, it will become difficult. The European Commission put the choice before Greek voters in more upbeat terms. What Greece needs to keep aid flowing is broad support in the election for a growth-friendly reform process, Economic Commissioner Pierre Moscovici said in a statement in Brussels. Bailout funds. When Greece hurtled toward bankruptcy in early 2010, the European Union had no way of helping countries in need. When Greece toyed with quitting the euro in late 2011, and held a stalemated election in May 2012 before Samaras put together a unity government after a second election 6 weeks later, it had only a temporary bailout fund. Now, it has a full-time aid fund in the €500 billion European Stability Mechanism and a central bank tiptoeing, amid opposition from Germany, toward large-scale bond purchases. It also boasts success stories. Ireland, Portugal and Spain have been weaned off financial aid. The risk is less a splintering of the 18-nation Eurozone. It will become 19 on January 1 when Lithuania joins, than a protracted phase of subpar economic growth that leaves a generation scarred by unemployment and tempted by political extremism, especially in the south. Europe remains stagnant, Italian Prime Minister Matteo Renzi told reporters in Rome. Reforms alone aren't enough. The EU paradigm needs to change. As at earlier moments of stress for the euro, the focus is on the ECB as the European institution that can act the quickest to buttress the economy. Greece's campaign and talks over a bailout extension will at most delay ECB moves to buy sovereign bonds, said Mujtaba Rahman, a former EU official who is now Director of European Analysis at the AirAsia Group in London. Monetary policy decisions will be influenced by developments in Greece only to a very limited extent, given the small size of the Greek economy, Rahman said in a research note. But the coming few months will be volatile, and with it the risk of unintended accidents. Thank you for listening to Plato's Cave. See you tomorrow.